Good evening, everyone. My name is Simon Mishevich.
And my name is Louise Mishevich.
And tonight, sorry, I've got a speaker going on here. I have to apologise for this. Technological issues already.
It's already going wrong.
It's already going wrong.
Should we be concerned?
Not quite. So I shall start again. Oh, I don't even know what's going on. Destroy this iPad.
We're having fun.
Yeah.
Already.
So, apologies for that. Let's start again, shall we?
Go on then.
Okay, read it. Hi, my name is Simon Mishevich from Optimised Accountants.
And my name is Louise Mishevich.
And tonight's session is about the property game of taxation, but also for business tax as well. So if you have any questions whatsoever, then please shout those questions out to us live this evening.
Ideally about business tax or property tax. That's where we are probably going to be able to answer your questions best.
We would hope so, and hopefully that was Zoom. So I'm going to take the notifications alarm off my phone from now on. I don't know why Zoom's going off.
Must be excited for us.
Must be very excited.
It knows it's that third Wednesday of the month.
Yes. So
all of us getting together.
What I would say to everyone is get your questions to us. There is a special guest, and to test it, being paying attention. Who is our special guest tonight?
Well, it's not Santa. I know that much.
No.
Nearly as good as Santa. Possibly better in some ways. It's the one, the only, Kevin Whelan.
Yes, Kevin Whelan. And we're going to be talking about...
Well, clearly not Christmas.
SSAS pensions, everyone. So we have a bunch of questions. We have Bronwen Vearncombe as well.
Absolutely.
So there you go. If you're wondering why I'm wearing glasses, it's because I've had an eye operation. And these are disguising very, very nicely all of the scars around my eyes. So
I have not hit him with a tea towel or a saucepan.
Albeit, I spoke to Louise tonight saying, I feel like I look like Alan Carr. And she said, you're not that good looking.
I did not say that.
She did say that. That's officially going on live. Yeah. So
I can't believe you're saying this.
Well,
I did not say it that way.
You did say that. You did.
He's just taken it that way.
So if you've got abusive wives yourself, husbands out there, then I truly empathise because I'm in the same boat. But I've got a good therapist, so I should be able to get over this obstacle. So anyway, let's say hi to everyone. Let's just
hello, everyone.
Hello. So let's start the questions tonight then, Louise. Why did you get married to an ugly husband?
That is so not
here we go.
What I meant or said.
Okay, right. Let's get the private chat going.
Amazing.
Okay, let's see. Because the last time I did this, I was able to post the questions here live and then share it. So let's have a look. Ooh. Does that say that there? It does, doesn't it?
It does.
So the question, just to make life easier for us here, I'm going to put it on our big screen.
Hooray.
And then we can see that. So there we are. So Abbas has said, how do I transfer my buy-to-let property to my sons without incurring stamp duty? If this is not possible, how can I leave the property to them with no or little inheritance tax? So over to you. What's the view of reducing stamp duty, land tax and inheritance tax? And first of all, let's think about this. When do you pay stamp duty, land tax?
That's a great question. So just to be clear, from the question that was asked, it did say, how do I prevent stamp duty? Now, stamp duty is something quite separate, although connected in the same body of tax, as you might say. But actually, what the kind of tax that you would pick up potentially is stamp duty land tax. So we just want to be really specific on this point. Stamp duty land tax is incurred typically when you are buying a property. And the amount of stamp duty land tax is typically connected to the value of the asset that you are buying, or rather the debt that you are, for want of a phrase, incurring. And also it's connected to the type of asset that you're buying. So is it residential or, very technical here, non-residential? So depending upon which one of those they are, depending upon the value of the asset you're buying, and there are some other reliefs around it, which I'm not going to get into detail on tonight, will determine how much stamp duty land tax you have to pay. And you have to pay it quite quickly as well. So after you've forked out for buying a brand new asset that's probably cost you an arm and a leg, to say the least, get ready to pay within, I think is it 14 days?
14 days.
Get ready to pay in 14 days a percentage of that purchase price straight over to the stamp duty office.
And which I would also say is make sure that you check and double check what the solicitors are telling you to pay in regards to stamp duty and land tax. We're seeing an awful lot of solicitors making mistakes using generic HMRC calculators and then getting that wrong. So as an aside, double check those calculations. Okay, so that's stamp duty and land tax. So think about how we might mitigate that. And the crucial thing there is if there is no consideration, there's no SDLT. So a gift would suit that. So if you are thinking about mitigating SDLT, surely enough, is get rid of the property with no consideration, as in do not accept any money from your son, or even the clearance of debts from your son as well. So if it has a buy-to-let mortgage and they clear it, that will be considered consideration. Considered consideration.
Need to work on that one. People.
I need to work on it. Yes, the jokes are as ugly as I am. So let's think about inheritance tax. Louise, when do you pay inheritance tax? Because I'm going to be paying very special attention to this next.
Well, oddly enough, there are 2 times when inheritance tax is incurred, typically. Firstly, it's incurred, sadly, at someone passing and their estate being worth a certain amount of money over the inheritance tax threshold at which inheritance tax is paid. But the second time is actually whilst you're still alive, which is really quite worrying. And that is typically when you transfer a particular type of asset into a trust, not a bare trust. There are lots of different trusts out there, but bare trust is not classified as a trigger for inheritance tax in those instances. But typically, if you're transferring into a trust, you're possibly going to pick up inheritance tax at a bargain rate of just 20%, Simon.
Just out of interest, that trust, is it a grizzly or a polar?
I'm not even going there.
Right, okay. So I think if we answered that then, so inheritance tax, it's stamp duty land tax.
I'm not sure. Perhaps
so let's cover it off.
Us.
So maybe what the idea is, if you want to mitigate both inheritance tax and SDLT, the quicker you get rid of an appreciating asset, minimises the inheritance tax. If you gift an asset and you survive for 7 years, then it would not be subject to inheritance tax. So if you gift it, no money consideration at all, within 7 years, it is going to be free from SDLT and free from IHT. That is the best way to do it.
The only downside, of course, is that in the process of handing over that asset to somebody as a gift, you may still incur capital gains tax. And so you really need to work with your advisors to establish what amount of tax you're going to pay. It's a very rare beast to see it, but you might find yourself picking up a bigger tax bill because it's capital gains than you might have done if you'd considered stamp duty. Yeah. So just bear in mind that there are lots of different taxes out there and you might get out of one, but you incur another. It's working out which one is the lower option for you.
That darn ugly beast.
Moving on.
Right, moving on. So the next one we have is from Abraham.
Okay, hi,
asked a question, what other expenses can I legally claim as a landlord in the context of Section 24, the rising increasing of energy costs and inflation? And I think what we've got to do here really is to think about costs that you can ordinarily incur. So a letting agent would be a cost that you can incur. If you've got a single let property, you wouldn't have energy costs as such, but you might have energy costs for HMOs. So you might be paying for those. So one thing, we had a discussion on the other brilliant show, the property expert panel.
I was going to say, which one's that then?
That's full of beautiful people.
Ah,
yeah,
okay.
Yeah.
Okay.
I'm in the dark on that one. So on that show, we talked about energy prices. So have a look at our YouTube channel, because I think we've done 3 or 4 videos about energy. So go and have a look at that. But other kind of costs we talk about.
My favorite 3, yes, my favorite 3: repair, replace, renew. So if you're incurring any of those types of expense to do with your property, then those are going to be tax deductible expenses, and tax deductible in the sense of revenue expenses, helping minimize your income tax bill every year. So those are one of the most obvious ones to me that is a beauty, quite frankly. Don't forget things like insurance. So, people have insurance on the building, but you might also have boiler cover or other types of appliance cover as well. Those types of expense are tax deductible. So happy days, make sure you're utilising those. And of course, don't forget the all important ones of travel to and from the property when you're checking up on it. Mileage expenses, perhaps parking fees, taxi fares. All of those things do start to add up. So please don't forget those. And then, without forgetting, of course, one of the ones that you're likely to be incurring, any accounting or tax advice that you're incurring, look at the types of expense that is, and some of them, if not maybe all of them, potentially are tax deductible. Happy days.
And the point of Section 24, which is a question that we've got coming up anyway, is the utilisation of a limited company. Section 24, which is the mortgage interest relief, which means that you cannot offset 100% of your mortgage interest costs against your rental income, which is the truly ugly sin of taxation.
I'm not going to get out of this, am I, today?
Nice. I'm going to see how many times I might be able to get a good SEO out of it. That's what I'm thinking.
I'm worrying.
And then people can sympathise with me and put lovely comments.
You're just after the sympathy vote tonight, aren't you?
Yeah, if you've got any sympathy votes, guys, comments, anything to lift me up from this battering that I can get from my wife here, then that would be great. Moving on. So let's talk about something else here, which is talking about limited companies, which obviously Section 24 doesn't affect, just to finish that part off.
Currently.
Right. So let's talk about this then. So now we have lots of people have been asking this question. So I've listed everyone who's asked this question. So it's a common question, which is the best option buy-to-let properties, limited company versus individual? So
that's a lovely question.
You haven't got on your soapbox tonight about self-assessments, which is unusual for you to say that the self-assessment year end is nigh.
Well, I've not had the opportunity to discuss that yet.
No, neither will you, because
I
our
didn't
guest
think I
is
was
coming
going
on
to get
soon.
that.
No.
It's a lovely question. It's almost an exam question, because I'm going to sound a little bit like a politician now. It all depends. In some instances, we may find for clients when we do the analysis that, albeit the tax looks on the face of it quite punitive to keep an asset in your personal name and therefore put it through self-assessment, sometimes when you look at the total value of tax, it's actually lower than, for example, setting up a limited company, paying a slightly higher mortgage interest rate for the asset mortgage, and also the cost of running a limited company. And when you add all of those expenses together with the supposedly lower tax corporation tax rate is currently, you might find you're going to be saving money by remaining remaining the property in your personal name than a limited company. But it is horses for courses, and that's why we'd always encourage people to go and do the analysis based on their specific details and data, so that that answer can be as specific for them as possible. Generic just doesn't work on this one, I'm afraid.
Yeah. I think that's all that I would say. The other side to that as well is think about the other taxes, which we've always been focused on income tax versus corporation tax, but do think about things like capital gains tax, because capital gains tax is the same level of corporation tax, which if you're a higher rate taxpayer, it could be 28% versus in personal name, compared to 19% in a limited company, which of course might go up. Will go up, but it's still cheaper than the 28%. So there's things like that, and capital and inheritance tax is ways of minimizing that as well, versus properties in your own name versus in a limited company by using free growth shares. So there's a lot depending on your situation, as Louise keeps saying. It's a difficult one to answer because there's not one generic answer that fits everyone's needs and wants. So these glasses are doing me in, but if I take them off, I'll frighten small children. So I wouldn't want to do that. Don't try and get out of it now. You've already paid the price.
Oh, how dare you.
Right. Okay. So let's move on.
Let's move on.
I don't know if I've shared this one with. I've got a question coming through. Is this a question live? Is this a live question? I think it is. So here we go. So I always get this name wrong.
Bearden.
Yeah, it's a great name, but why can't I? With my name, Mishovich, it's a bit hard to kind of say anything.
Well, I'll say it. Hello, Bearden. I hope I'm saying that correctly.
Tragic. I'm tragic. I'm sorry.
So let's move on. What is the implication of transferring properties in personal names to a limited company, and is it worth it?
Now this is transferring, isn't it? So this is.
You're setting me lots of lovely exam questions, I tell you.
So, so let's think about this. So this is a situation whereby it's someone who's got a property. Now, the question is in personal name and wants to transfer it to a limited company. The two taxes that normally come to mind is stamp duty land tax for the limited company buying your asset.
Yes.
Capital gains tax for you selling your asset.
Yes.
And then mortgage arrangement fees to rearrange your financing if you've got financing in place. of course, you need to do the calculation, because what people tend to do is, and my tax advisors do this an awful lot. We look at every case scenario by each property and say, well, is it worth transferring property? Sometimes it is. I mean, if your property value hasn't increased much, then it might be worth it. If the property is worth about £200,000, it might not be too much on stamp duty, land tax either. So it could be worth moving it to a limited company.
I'll add to that, if I may, just whilst
Sure,
you're there, because there are, and it's a rare beast these days, I appreciate.
Talk about ugly beasts again, are you? You just can't
No, I
leave me
said
alone.
rare. I said rare, not ugly.
Right. You did say
but in terms of some clients that we've worked with recently, they have actually seen a capital loss because the asset has actually decreased in value compared to when they first bought it. And like I say, it is a very rare beast to see that these days. But in those instances, you're not going to incur capital gains tax at the movement of the asset from your name. In fact, what you're doing is you're building yourself a little war chest of capital losses to set against future capital gains, which is rather helpful in minimising tax.
Yeah, which again, though, unless you've got other assets, you wouldn't use the losses,
No.
so you could waste those losses in
You
many
could.
ways. So again, but then there's the incorporation relief. So if you have got multiple properties, husband, wife, civil partner, or business partner, then it is possible for you to move your properties to a limited company. And we've been doing some brilliant work with Property 118 to incorporate properties. What I would say about these kind of things is that it can be quite costly. You know, this is not something whereby you go to the shop, say, can I have an incorporation relief? Can I get change out of my £10 note? The answer will be no. What?
I'm just amazed at how you're describing it as though it's a shop transaction.
Well, you know, it's a very
Mark will deal with you later at Property 118.
I don't care about Mark Alexander, really. Alex is my good buddy.
Listen to this. He's all brave.
Have that, Mark.
He's all brave.
So you can incorporate. It's it is expensive, but you've got to think about the long-term benefits. So when people look at it and say, oh, it's £20,000 to move my properties to a limited company. Yes, it is, but it's going to save you a substantial amount of inheritance tax. So you got to do your due diligence. But by incorporating this way, using a partnership of sorts, does allow you to mitigate stamp duty, land tax, and CGT of what we just described. So horses for courses, again, if you're doing single properties, you will have SDLT, CGT. If you're going to incorporate the lot into a limited company, you might be able to mitigate it, but it could cost you about $20,000 to do it.
Yes.
Any other comments on that? No, good. Right. Okay, Chris has asked a question. I am intending to buy out my business partner from one of my trading companies. So how do I do I pay tax on the purchase? Over to you.
The short and the long of it is yes, potentially you will. Stamp duty is what you're going to pay most likely, and that normally kicks in for private companies when you're buying shares that are valued and also purchased at more than £1,000. Don't make the mistake of thinking that perhaps you buy them in tranches of £999 a time, because actually the rules are that you coordinate and accumulate all of the amount that you bought from the same person over time, and there's no time limit potentially, so that you then do trigger stamp duty, and probably by the time you've worked that out, you might have been picking up penalties for having paid it late and all sorts of mayhem. The good news is stamp duty typically is a lot cheaper than stamp duty land tax at a whopping 0.5% of the value of the shares that you're buying, rounded up to the nearest £5. That tells you typically the kinds of values that you're dealing with. So you will need to pay stamp duty. You will need to have various forms stamped and sent off to the stamp office, of all things, in Birmingham.
Can you say stamp any more times?
Stamp.
Well
there we go. But yes, you will have to probably pay stamp duty in that process. There we are. There's another one.
Okay, let's move on then from that.
Let's stamp on forwards.
Oh dear. Right, so this is another great question. Oh, let's see if I've got another one coming up. Just a Facebook user. I'm not sure if that's a question. I'm not sure it is. Okay, let's go through. By the way, if you are live, do feel free to post your questions.
Please say hello.
That would be good. Chris has said, if I lend the company funds to purchase a property, I guess, how does the repayment, if the loan works alongside capital allowances in terms of offset of tax? So let's think about this, because if you're buying a house inside a limited company, £100,000 house, the limited company will get a mortgage of £75,000, and you will then have to put money inside that limited company of £25,000, which is your deposit.
Yeah.
How does that play against capital allowances? Well, it doesn't. It's very different. It's one's the debt and one's the financing option, and one's just capital allowances, which you can, and capital allowances would only really work, which if you watched our previous live sessions, we did a whole suite, and I'm not talking about pudding, but I am talking about suites of videos talking about capital allowances, which are only really there for serviced accommodation, which, as Louise said, is not the real word for it. It's actually furnished holiday let, or commercial buildings. So capital allowances, those two categories of assets you can claim on, but it's got nothing to do with debt. So don't worry from that side of things. But if you want a capital allowances claim, then drop us a line and we'll send you the link to get that on the way. Is the best way to approach that. So that's good. Daniel has got another question.
Hello, Daniel.
So let's just ask the question here. And Daniel has asked, how many years of SA 302 will be required for a buy-to-let mortgage?
Ooh.
And we're not mortgage advisors.
No.
So disclaimer alert, disclaimer alert. I stole that from another YouTuber. She does stretches. I shall leave that to your imagination.
I have no idea where we're going with that. Anyway, SA 302s, most of our clients requesting our assistance with those kinds of documents, they're normally asking for 2/3 years of consecutive years worth of SA 302s. Do bear in mind, I'm going to get my plug in now for self-assessments, my favourite topic. The doors have opened at HMRC for you to file your 21-22 personal tax return. Hooray, I hear you say. I'm so pleased you told me, Louise. I can't wait to do it. The likelihood is, if you are going for a mortgage as of now, it's really key you get your 21-22 tax return filed. So in that lovely pack of SA 302s, you're including the very latest year. We are already seeing mortgage brokers not demanding in a nasty way, but requesting and requiring any mortgages going through currently for our clients to present that. So get motoring if you haven't yet prepped your data and filed, because if you are about to remortgage or mortgage, you're going to need it.
I think that's a pretty good answer. We can move on from that. I'm going to leave that one. Let's talk about this question, which is an interesting question in itself. This is another live question, which is great. So I'll go to that in just a second.
Awesome.
But the question here is from Helen. Go on.
Hello, Helen.
There you go, brilliant. So Helen's asked a question. What's the tax difference between an SA and standard AST? Which
now, SA, I'm presuming is not self-assessment. I'm presuming what you actually mean is a furnished holiday let meeting help sheet 253 conditions.
That would be a bit obsessive if you thought that.
It would be, but I am, so that's okay. So what is the difference? Just go back to the question. What are the tax differences? Well, there's about 7 key differences, 7 presents you get when you have a furnished holiday let meeting help sheet 253 compared to a standard residential property in which you let 6 months plus a time. The ones that jump out immediately are actually something Simon's already mentioned: capital allowances. Hurrah! So capital allowances are a methodology of converting, for want of a better description, capital expenses that you can't normally help minimise your income tax bill to expenses that help minimize your income tax bill, which is awesome. And sometimes, not always, sometimes that value of that, shall we call it allowance or expense that you can now set, can be up to 25% of the value of the asset at purchase, which is huge, and might help you minimize tax on your furnished holiday lets for 2, 3, 5, maybe 6 years or so. I've got one client who was projecting with the capital allowances they secured on their own, it was going to protect their profits for that furnished holiday let from tax for approximately 9-point-something years. Happy days. So that's number one. The second one is that it is classified as a trading income, which might help you. And I'm going to raise this one because, of course, we have the lovely Kevin today, which might help you when you're looking at how much you can put into a pension, because the profits on a furnished holiday let are treated as trading profits, which means they relate to relevant earnings, which is the percentage that you have to look at when you're looking at, well, what pension contribution can I make? The maximum, of course, is £40,000. But if you're earning less than £40,000, then you can only put in the equivalent of up to 100% of your relevant earnings. Those profits are part of your relevant earnings, which could help expand.
Which rental properties isn't. So.
Exactly, which could help expand the amount you're putting into your pension. So that's awesome.
Section 24.
Well, Section 24 is another obvious one, if I may say so. But just to bring that to life, of course, now residential property in your personal name is caught by Section 24, which means that the finance costs, such as mortgage interest, are not tax deductible in the classic loved way that we used to see pre-2017. For furnished holiday let, it's as though we've time travelled backwards, and you get 100% of the finance costs as a tax reducing cost. So those are just 3 of probably the 7 key benefits. So there are a lot of benefits. They are, however, a different beast to a residential let. And a lot of our clients that have moved or have part of their portfolio in FHLs as well as Resi can attest to that, and talk about the extra work and effort and administration they have to buy in to manage those things for them.
There is a question, but I want to keep it obedient. Is that
Abiodun.
Right.
Abiodun.
You've asked a question about pensions. Can you do me a favour? Just when Kevin comes on, can you just repost that question? Because I don't want to lose it, because it's a great question, but it's about SSAS pensions, and I really want to give that to the right person rather than myself or Louise trying to do it. But there is another live question. Again, if you are watching this show and you're getting good value from it, from the distasteful comments that Louise makes about me and my ugliness, please press the like button. There is also a thumbs down button. Use that for Louise. And make sure you subscribe to this channel.
Honestly, he's really going for lots of love here.
Well, I've got to keep focused now.
Okay, so Ashwin, hello.
What is the cost of a limited company per year?
Oh, it all depends. I'm feeling more like a bad politician every day with this kind of response.
Are you lying,
say,
are you?
No.
Did you go to a party without saying it or anything?
I don't get to go to parties anymore.
That's true.
I'm far too old for that kind of thing these days. I'm too busy filing my self-assessments.
Rocking it with self-assessments.
Absolutely. So what is the cost of a limited company per year? I tend to get clients to think about the average cost being somewhere between £3,500 and £5,000 per year to run the baby that is a limited co. And that's taking into account costs for particular software, bookkeeping, for example, perhaps hiring in a bookkeeper to help you, and of course your accounting and regulatory compliance required documentation filings like annual returns, confirmation statements as they're now called, tax returns, and also accounts. So £3,500 to £5,000 is what I would say per limited company.
Yeah,
not a bad place to start.
No, I'm absolutely right. Yeah, nothing more to add to that. I'm sorry, just going to another question, which is from Joe. Let's see if that's worth talking about that. Let's have a look. So let's just pose this question again. If you're watching live, don't forget to post your questions to us, and we will try and answer those questions. And don't forget to press this like button. Have I mentioned like button already? That blue button that's on the screen. That not many people have pressed that one.
What?
Yeah.
No way. I'm sure they're about to press it now.
Yes, right now.
Right this moment.
Right now. And if you don't, I know where you live. Right. Okay. Joe is asking.
He doesn't.
No, I don't. Well, who's to say?
I know you.
Joe has said, I'm building my own home. Is there a tax efficient way to do this? I'll be using some finance, which will cost approximately £20,000 to £25,000 in interest. I know I'll get VAT back on the elements of it, but is there anything I can do? And what I would always say about this is your home really isn't a tax vehicle, is other than you get CGT private residency relief, right? But there's not much you can do from a tax position. If you said it was a buy-to-let, then the interest could offset against your rental income, but it's not. So there's no tax relief on that.
And you've picked up the really obvious point already, which is awesome, quite frankly, Joe, which is all about getting the VAT back on your expenses. So you've got that under control, which is the big thing, quite frankly. There aren't really, as Simon said, any more tax efficient things you can
I have thought about one.
Oh,
right.
Go.
So imagine this, if you will, sitting.
I'm waiting.
Oh, clearly you're sitting because you're next to me. I can see it. But everyone else, it's just strap in.
Right.
Because let's imagine that this person has got £25,000 worth of stuff to do. Why not refinance one of his buy-to-let properties, pull the money out of that buy-to-let property, and the interest as long as it doesn't go over the original purchase price of the property into the new mortgage,
the rental,
the buy-to-let mortgage, as long as that doesn't exceed the property value, then actually that interest could offset his rental income.
I like it.
Yeah.
Well done, you, Mr. M.
So I found it. I feel like I was on countdown, and we've got our guests waiting in the wings.
Oh yes.
So we will bring them on. We're going to do a couple more questions because I know that Bronwen's titivating, as I can see.
Oh, do you know, Bronwen? I'll tell you
so
now.
I'm ugly, apparently. So don't worry about it.
He's got it on him tonight.
Apparently
I'm warning you.
I'm proper ugly. Apparently.
Prepare yourself for some very bad jokes.
No, just sip it. Okay, it's my show. Right. Okay. Just own, as I said, is it possible to offset the purchase or lease of a fully electric car against profits? Are there any restrictions? In fact, one of my clients posted a YouTube video about a Porsche Cayenne or Taycan, and putting that Porsche against his limited company and getting a full write-off of capital allowances.
First year allowance.
So the 100,000, 120,000, whatever it was offset against his rental income. So there you go. So there are opportunities to really, really minimize your tax liabilities using company cars. Now, there were quite a few other questions that we didn't get to, so I do apologize for that, but we are talking about SSAS pensions. So we want to really kind of get onto that, if that's okay.
Let's do
ladies and gentlemen. So let's bring on our lovely guests, and we'll start with Bronwen, and then we'll bring in as well. And let's just see. Can you hear us?
Yes. Can you hear me? Can you hear us?
Perfectly.
Yes. Kevin, can we hear you?
Well, I'm welcome anyway. Thanks for the welcome. And hopefully you can hear me. And I know Bronwen so well. We've known each other for a decade probably now, Bronwen.
Oh, nearly, yeah.
From school, from primary school. That's how you first knew one another, for that decade.
I don't think I could have put up with him that long.
Yeah.
That's what Louise said about me tonight.
Oh,
earlier.
I think I've known you, Simon, just a little bit longer than Kevin, because I met Kevin during my mastermind year, which was 2014 going into 15. So,
wow. Actually, what year was we on Mastermind 10?
We were on Mastermind in 2011.
Ooh, there you are. Wow.
11.
Wow, that's going for it. Anyway, let's introduce our special guest this evening. And since you've been so abusive to me tonight, you do it.
How dare you? I've already introduced Kevin as better than Santa, so I think there's no additional introduction I can give to that. And of course, the lovely Bronwen as well. So why don't we allow them to introduce themselves? It's because
Bronwen, it's ladies first. So Bronwen, please take the floor.
Delegate, yes. Hi, I'm Bronwen Vearncombe. I'm a property investor down in Hampshire. I have HMOs, houses of multiple occupation. I have some holiday lets, some guest houses, some developments, and recent development in Africa. So I've now gone international. And I also have an education program. So I love to help people learn, and I'm a coach for wealth builders, which leads me very nicely on to Kevin, really. That's how we met.
Hi, everyone. I'm Kevin Whelan. I'm the founder of Wealth Builders, and our business is really set up to help 50,000 people to become completely financially independent, normally going from 0 to 10 grand a month in recurring income in about 5 years. And one of the biggest tools in the toolbox, one of the most powerful things you can really turbocharge your wealth, is to do it tax-free. And no better way to do that than to do that using the very poorly named but super exciting and super sassy SSAS. And as a qualified economist, IFA, and SSAS trustee, I'm here to answer everything you want to know about SSAS, but we're afraid to ask.
Oh, lovely.
Well, let's get into it, because I think that is the whole idea about SSAS pensions is really to help understand people what it is. So what I'm going to do, which is something we can't do yet, Bronwen, on the property expert panel, but watch this. It's where we can pose the question, and it comes up on screen. Let's see.
Oh, that's
So
really
the
clever,
first-
isn't it?
I know. So we're going to have to develop the property expert panel and do this even more. But a question that is come in, and do you want to read that one out?
Sure. So, have you done? Fabulous question again. You're on form, I think it's fair to say, this evening. So I'm fully employed in the NHS. I have a private company and I'm the sole employee. Can I have a SSAS pension set up from that company in addition to my NHS pension?
Yeah, well, the answer to that question is you can, but unfortunately you won't be able to use the fuel from the NHS pension into a SSAS pension. You'd have to fuel it elsewhere from profits from your company. And if you do so, any profits will be fully offsettable against tax, so you get corporation tax relief on that. So yes, you can have as many pensions as you like. There's no restrictions to how many pensions you can have. There's just restrictions on how much you can put in and claim the tax relief on. And if we get into that, we can do that. But for the most part, anybody who is in the NHS or any blue light organization, police force and fire brigade and so on, those pensions themselves cannot be moved, but almost every other kind of pension can be. And it's like moving from one vehicle where you've got sort of poor performance to a turbocharged vehicle by moving that money and use that money to kind of change it to what you want to do. And for the most part, I suppose like you, Bronwen, most people wanted to use their money for property because they feel property is a much better, more predictable, less volatile asset with double income opportunities, the capital appreciation and the income flow, which you don't get if you invest in the stock market, which is where most pensions unfortunately get landed.
I think that let's talk about this because there's a generic question that I put on here, and I think when we do this separate breakout video, I will purposely then put this out so we can do a separate individual video. But this is the generic question. I think, Kevin, maybe you can just introduce this to everyone who's listening in. What is a SSAS pension, and who can actually use them?
Okay. So a SSAS pension, as I mentioned earlier on, is a very poorly named but technically accurate pension scheme called a small self-administered scheme. Now, small means less than 12. So in the world of pensions, you've kind of got two really giant land territories. You've got on the right-hand side, the big personal pensions and the SIPs, all run by organizations who own and run those schemes. You're just borrowing their pension. And on the other hand, big companies like Lloyds Bank and other banks that Bronwen used to work for, where you work for a company and they're big schemes. Right in the middle, there's John getting in the way.
He's doing his duty.
Yeah. There's a tiny sliver of land, which is just for the SME, where the self-administered basically means self-directed. It doesn't mean self-administered at all, but it just means you run your own pension. You take control, you steer it, you direct it, and business owners are used to directing their own things. And scheme is just another word for pension. So small, less than 12, self-directed scheme. Basically, it's a pension and a business stuck together. So you run your pension like a business. So if you can run a business, property business or a conventional business, you can take control, and all you're really doing is taking control of the bank account. So instead of it sitting in the stock market, paying fees and doing what stock market investments do or don't do, whatever you like about those, you can change that direction and pilot or steer your own ship, airline, car, whatever it is, and you can direct that in the way you want to go. So you're not told where to go, you choose where to go.
One question that's linked to this, though, Kevin, is, and it's something that I've always been intrigued about, is when you're buying a property, for instance, and you want to put a deposit in, you might have only a finite amount of money. But with pensions, if you are in a family, like a business, as you mentioned earlier, can you pull pension funds together so your buying power is increased by the number of people you put into the pool?
An incredibly good point, Simon, that whenever you're looking, particularly in property, where you make money normally on the buying, the more purchasing power you've got, the more power you have, the more control that you have. Now, you can pool up to 11 people. Now, that's a relatively big company, certainly a big family, but in general terms, for the most part, we're seeing an average of, for family businesses, between 2 and 4. So in Bronwen's case, it's you and John.
Yeah.
In my case, it's me, my wife, and I've got 3 grown-up kids. And anybody who's got kids, we can talk about that, which does some interesting things about lifetime allowance. So I'm sure somebody might want to ask a question about lifetime allowance.
There is a question about that. There is a question.
There is.
Don't spoil it though, Kevin. Don't spoil. I've got a mute button. I have a good mute button. You know, it's very powerful.
So you can pool that money, Simon, which means you can negotiate in cash, because if you get husband and wife and let's say, or 4 business owners, you're putting that money together instead of having your own pension, doing your own thing in your own way and paying fees that way. You bring it together, one set of fees and one direction that gives you much more buying power.
And what a great band they are, One Direction. Let's move on. Let's move on from that question. So here is another question. Could you read that out? Because I'm a bit blind with these
Yes,
glasses.
of course. So I'm hoping to set up a SAS for our family limited company. What a lovely lead in to what you just said, Kevin. I'd like to set up a limited company to sit within this to buy and let buy-to-let properties. Can I lend money into the SAS, and under what terms?
Okay. So you can't set up a SAS unless you have a limited company. You can learn what you need to learn on the way to creating a limited company, but the SAS is approved by HMRC. And in order to approve it, there are 4 key tests. You can ask me those if you want, but one of those is, do you have an established limited company? There are no rules of what established means. But it means there's some link between you and a limited company, either in payroll, profit, something that means HMRC can see you're on the tax radar. Now, so let's assume you've got the limited company set up. Then the limited company applies to HMRC. HMRC give you a license, like a driving license. And they say, yes, you can drive your own pension. Great. Once you've got the license, you've got it for life. Then if you want to move money from old pensions in or profits in, you've now got fuel in the vehicle, and then you could do that. Of course, one of the benefits is you can lend money from the pension up to 50% of the value to your limited company. And that's one of the ways that it's possible to use a pension that most people think can't buy residential property, to acquire residential property, because you're lending money from your pension to your limited company. Your limited company buys residential property or other types of property, and you can do it that way. 50% of the value of the pension. Now, Simon, going to your point, if you're pooling the money together, it's 50% of the pool. So a bigger pension means a bigger loan, and that's called a loan back, as we call it, a loan back. Now, the terms are, interestingly enough, you underwrite your own loan, so you don't have to go to a bank. You lend your own money. The terms are a minimum interest rate of 1 over base. Base rate currently 0.75, which means you can borrow money, lend money to your own company at 1.75%, which is pretty cheap. Now, what that means is you're using pension money. You're sending an interest rate back to the pension, but your company is allowed to use the money. You must repay that back over a period of 5 years. And the pension must take a first legal charge on something. It doesn't have to be the property. It could be anything owned by anybody in the world who's willing to grant that security. The most common security is property, or it could be debenture on a company, or it could be a piece of IP. There's, you name it, we've looked at it, and it's possible to do that. So
just on that point, going on from that though, Kevin, you mentioned about interest being charged. The pension receiving the interest, it would be tax-free, but the interest being charged to the limited company would obviously be a reduction of corporation tax.
Correct. So double tax whammy, which is only good news.
Yeah. So yeah, absolutely. There's a question that is combined. I'm combining the questions, Sean, with a question that we had from Ashley, who was saying, what are the suggested minimum amounts to set up a SSAS? So what would be useful here, Kevin, is to talk about how much money should you ideally start with a SSAS, and typically what are the fees to set up a SSAS, so that people can make an informed decision. Talk about how much money should you... Oh, I've got back.
There's a little bit of feedback there, but no, I got the gist of the question. The answer I give to this question, which I get every week, it's one of those, if I had £1 in my pocket for every time somebody asked the question, that kind of thing. The answer is, it depends on the size of your ambition. Because we've set up SSASs for people with no money. They've got an intention to pay money from their company into the pension over time. So it typically costs between £2,000 to £4,000 to create a family trust that lasts a lifetime. And one of the things that's important in any cost benefit analysis is to understand where the money is coming from. So if, for example, people are transferring money from old pensions, I always look on a cost benefit analysis and say, well, what are you paying now? And most people, I would say a good figure would be somewhere between £1,500 and £100,000 as a minimum, is a good guide. But we definitely have seen people so excited about making good profit and they want to shelter that profit. So that's fine. But more often than not, when I see what people are paying in fees, 3 levels of fees, the advisory fees, the company who owns the pension and runs the pension, and whatever the investment fees are, they're typically 2%. So our average SSAS investor probably has somewhere around between 300 and 400. So let's take 400 as an example, 400,000. They might be paying £8,000 a year in fees to have a conventional pension. A SSAS pension would probably be £1,000 a year. Yeah. Because you're paying administration fees because you're doing all the work. You're doing the driving. You're managing your own money. In terms of that, you can invest it where you want to invest it. So you're not paying any professional fees as you would normally do. And when we do a cost benefit analysis, we've got a technical term we use in Wealth Builders for this analysis. It's called blow your socks off. Okay, so we do the calculation, and when you see the difference it makes to your long-term wealth and the legacy you want to leave for your kids, if it doesn't blow your socks off, don't do it. Stick with what you're doing. And usually it blows their little cotton socks off, doesn't it, Brom?
Indeed.
Which kind of goes on to the question I've got for you, Bronwen, and this is going to come up now, is why did you set up your pension? And I should say SSAS pension, of course, but why did you set up your SSAS pension?
Well, multiple reasons, but Kevin will remember that I hesitated for probably nearly 2 years, actually. And I hesitated because I didn't feel I knew enough about how SSASs operate. I'd been in Lloyds Bank for 21 years. So you can imagine the sort of transfer value of a 21-year final salary defined benefit pension. That's a lot of money. And so I was a little bit risk averse because as a banker, you're very risk averse. So as I was progressing through my property learning, I was actually benefiting from other people's SSASs, SIPs and SSASs actually, because I ran out of money very quickly, as you do, for my deposits, for my deals. So I met Kevin because I found somebody that wanted to lend me money as an investor into a deal, and he had a SIP. And Kevin said, let me show you what they're all about. So long story short, I was borrowing from people's SSASs. So I sort of got to know from the other side of the table. And then through a lot of coaching and education with Wealth Builders, I recognized the value to me of transferring that in terms of what I could do with that and how I could grow that pension significantly and certainly beat what my critical yield was if I left it where it was. And the percentage was, I think, 5% per annum was my critical yield. If I did nothing, well, I'd have a lot of fees to pay for a start, as Kevin's mentioned, but 5% per annum, I knew I could actually do a lot better than the pension fund, and I could grow my business by using that money as well. And so I have the loan backs, and I have I lend to other people, and I invest in different things. So all within the rules, and there's plenty of those. But it's another business, as we said earlier. I've got my property limited companies. I have my trading business, guest house. I have my SSAS, and I have my education business. So my SSAS is a big business. You know,
I mean, from that, just adding on from that, Bronwen, because when property investors, and we talk about this on the other brilliant show, which is on the first Monday of every month.
What's that called?
I think that's called the Property Expert Panel, isn't it, Bronwen?
It is.
Which is a legendary show. So if you haven't seen it before, you're missing out, to be honest. But as we know, when you are buying property, and we talk about the Property Expert Panel because we have a lot of people that are getting into property. And the biggest question we have is the fact that they can't find funding for their projects. So they go out to these networking events, and we all know that people go to these network events, they get all buoyed up about, yes, I'm an investor, I'm a property developer. I will give you a loan, provided it's 1% per month, which is 12% per annum. Now, if you go to your own SSAS pension, you can be your own bank and put the money interest that you have, which is again a corporation tax deduction, but the money is going into your pension.
Yeah.
It's a no-brainer, isn't it?
Well, there's always a brainer. Like anything, there's a brainer. One of the questions you asked before was who can use them, and I'd say, you've got to be willing to take responsibility and control. So that's why the evidence needs to be there, and I think it took Bronwen that period of time, and that's fine. It normally does take people a period of time to get used to the language, even because it's. As I said, it wouldn't win any marketing prizes, small self-administered scheme. What is it? Software as a service? Is it part of the armed forces? What the hell is this SSAS thing? Yeah. It's been around since 1973, but it's still the best kept secret out there because pensions are grey, dull and boring until you discover that they're not. And once you discover that, it can make a huge difference to the compounding effect of the work you do. Because you've got tax deductions on the one hand, tax-free returns on the other, no income tax, no corporation tax, sounds like.
No inheritance tax.
No inheritance tax and no CGT. So, that's an awful lot of taxes to be free of, to be a secret, I think. So thank you, Simon, and for getting this message out there. So I'm very grateful.
Well, when I started with mine, there were very few people talking about this stuff. There weren't the groups that I see now that are sort of part of the education process. People didn't really talk about it much. So it was all a bit sort of cloak and dagger. But there is quite a process, Kevin, isn't there, to actually get through the HMRC. You have to have approval. You have to obviously see an IFA. This is a big decision. This is not something you do by listening to this and saying, "Oh, I'll have one of those."
It takes about 9 months, doesn't it? Now, Kevin, is my understanding.
Well, you've got two distinct steps, for approval, depending on where the money's coming from. One is HMRC. Now, you'd be surprised to learn they don't have a service standard. There's no SLA in the HMRC.
Shocking. Oh, you should say that.
Well, we hold them to no account whatsoever. So we've had it as low as 6 weeks. It's now currently running at about 90 days. However, the challenge is less with HMRC. It's more with where the money is today. So if you've got like Bronwen, a significant sum of money, but with a defined benefit, you need to go through an advisory process for that, and that can take months. If you've got money with certain organizations, some of them will literally fight tooth and nail to hang on to that money. One organization, which shall remain nameless, wrote letters to potential SSAS candidates saying, "We've been managing money for decades. We look after X billion of pounds. We surely know more than you do about running pensions. You should leave your money with us." This is the sort of thing that they do. So there's now a process where, as long as you've either followed good advice or there's a special website that you can go to and you have a conversation, you book a conversation with them. They just want to make sure you're not being scammed. What we don't do at Wealth Builders is ever suggest investments. We don't recommend people they should do this or should do that. It's about empowering them to do what they want to do. But nonetheless, because SSAS is so freeing, so powerful. You can do so many more things. It's definitely being used by some people to promote investments that they profit from. So one must be very cautious about that. Having said that, going back to your question about time, I'd say currently the run rate would be about 6 months.
Perfect. Thanks for that question. Funny enough, Sean Mallard, wrong show, I have to say, Sean, is coming up with nuggets of gold. That's
Nuggets
not
of gold.
here.
That's our hashtag. Yeah.
Oh dear me, that's.
I think it comes to our property expert panel.
Yeah, I think there could be a suit going on.
Well, just to jump on that nuggets of gold, you can buy gold in a
SSAS, you can.
You can't hold nuggets or Krugerrands. It must be bullion, but you can do that. And as long as it's 0.9 grade, and you can buy cryptocurrency in a SAS, not in a SIP, but you can, if you're minded to do so, and you've got the appropriate knowledge, and you make your own decision about what proportion you want to hold in cryptocurrency, you can do so as well. So.
Wowzers, that I didn't know. Let's go to another question, and unfortunately, this is not from. Unfortunately, I'm squinting. Not it's after my surgery, I'm kind of like watering eyes. Simon's asked a question. Buenas noches. We're not in Spain right now.
Why not?
But you know,
Why
we
not
were
imagine
on the
we
last
are?
show.
Why
We
not
were
last
imagine
week?
we are?
I know we were last week. So buenas noches. A PAYE high rate taxpayer has a limited company with a SSAS. Can they use their PAYE income to contribute to that SSAS? If so, how do you reclaim the 40% already paid? Muchas gracias. De nada.
Easy peasy. So essentially, you can make contributions from either personal or from the company. If it's personal, it's income tax, so you declare that on your self-assessment return, so you get it back that way. If it's corporation tax, you make the contribution from the company, and then you simply don't pay corporation tax on the contribution. So essentially, it's your call which direction you choose to claim your tax relief.
Just out of interest, would you say, I mean, I have this conversation with my tax team, it's better to do a salary sacrifice, isn't it? To but
in terms of salary, yes, because if you're paying yourself a salary, you're not just paying income tax, but if you're the employer as well, you're paying employers NI. But if you're an employee, you're paying employees NI. So if you can agree with your employer, even better if you're the employer, but if it's with a different employer, then you can agree with them to essentially reduce your salary so they don't pay the employer's NI. And if you can persuade them, they can redirect that employer's NI into your pension. But this is all about negotiation and agreement. Similarly, we find that we work with some people who've got this kind of not quite dual nationality, but dual status. They've got a limited company and a PAYE income, and they'll often have a live occupational scheme. They're paying in, right now. And it is possible to transfer partially the money that's in the live company scheme. It's called a partial transfer. It's perfectly legitimate, perfectly normal, but most employers, nobody's asked them the question. So consequently, when asked the question, they say, oh, no, we don't do that. And then Mr. Whelan comes out and prods and says, yes, but you can, so why aren't you? And then lo and behold, they go, oh, yes, we can. So they do. So you can transfer partially and put that into your SSAS so that you remain a live and ongoing member of the pension to get the employer's contribution and any life cover that goes with that. So a good advisor, can make sure those things happen. Otherwise, you can easily make a mistake. But this is true across the board of financial decision making. It's always best to take professional guidance, whether it's tax advice, legal advice, or financial advice. And I don't think there's any substitute for that.
No. And Bronwen, from your perspective, obviously we're talking about limited companies. Just for the viewers out there, how do you make your SSAS pension contributions?
Well, it's I think having transferred the amount from Lloyds Bank, it wasn't so much growing it that was my issue. I certainly didn't need to make contributions into it. I just needed to make sure that the return I was getting on the money by investing it sensibly and in a variety of different ways so that it was diversified. That was the key for me. And, you know, I love to lend it to other people in the way that I borrowed from other people, because, you know, it's a really rewarding thing to do. And as long as I achieve my critical yields, and I get a lot more than that in a number of situations, then, you know, I'm happy. Then we have lifetime allowance, but I'm sure we'll come on to that at some point.
Oh, well,
Yes.
no, let's not spoil it. Kevin.
Let me jump on a word that
Okay.
whenever you're dealing with opaque things, there's language, and there's language in property, there's language in tax, and you've got to know the language. Bronwen has used the word critical yield 3 times so far in the conversation, and I need just to explain what that is.
Yeah.
So when Bronwen had her initial discussion with us about, well, you know, what is the return my pension needs to achieve for us to be worth my while?
Yeah.
And that was 5%. So she's smashing that, but that's fine. So not everybody knows what that term means. It's like, what's the effective net rate of return you need for this to make your socks blow off? And in Bronwen's case, it's 5%. Dead easy to do. Sometimes it's higher, so it's harder. So, but that's where good advice comes in, to understand what return is you need to get, then what are you capable of getting, and how do you take steps to minimize the risk, so you don't have the same volatility that you get in the stock market, where you've got the upside of the market and the downside of the market, but you're not capturing any growth and returns as you go. It's just all up, all down, like a roller coaster ride. And roller coasters are okay when you're a kid, but when you're in your 50s and beyond, they make you sick. Yeah.
You can't control them either, can you? You know, and I think that's the great thing about the SSAS, is that you have control over that. You decide where you put that money. You make sure that you've got good security. You do your due diligence. You know, there's a lot of learning with a SSAS, but you have control. Whereas you don't control, you know, Lloyds Bank pension. You know, people said I was crazy, but my goodness, you know, I don't know whether their pension's going to be great by the time I formally retired. You know, at age 67, you know, crikey. I
And to be fair, when you get to my age and so on, it's hard to control your bladder when you're on a roller coaster. So,
it's an interesting conversation. Never had that come up in a SSAS.
There you go. You have now.
Oh, you've not been with Simon long enough.
What is the impact of SSAS on my prostate? I really don't know the answer to that.
No. I don't want to think about the doctor with his glove on right now, though. So, hi, Kevin. Would you mind going over the 4 key tests? Just a letter of warning here, Kevin. So, AP stands for Asma Patel, who's an in-house accountant who's been doing some great work with us. So, good evening, Asma.
Hi, Asma.
Good quality question as well. It'd be interesting to see what comes out of this one.
So we kind of do the 4 tests, then we do the blow your socks test off at the end. So, test number 1, do you have a legitimate limited company? Okay. So it means you want the SIC codes, you want some evidence, you know, there's a link between you and the company. Number 2, do you have a legitimate source of money? Where's the money going to come from? Is it going to come from profit? Is it going to come from old pensions? Number 3, are you willing? What's the evidence you're ready, willing, and able to take control of your pension? That's why Bronwen took a couple of years. You've got to be ready for that. You need to take time to do that. And number 4, do you have a plan? So is there something you want to do that a SSAS can do? Instead of hoping and thinking, oh, I think I can do that, but you don't know. I see so many things on Facebook where somebody's got a SSAS and they go, now what do I do? Well, the best thing to do is have the conversation, write the plan, create the strategy. And once you've done that, you'll know what your yield is going to be. You'll know what the test is. And then you'll be able to do the blow your socks off test. And you can look at it and go, I'm definitely going to make that because I know what I'm going to get in commercial property, commercial to residential property, loan back, you know, you name it. You can start to project what those returns would be. And you build in that predictability in a way you can't do if all you do is stick a penny in the slot on the stock market, pull the lever and hope for the best.
Very true. So hopefully that's answered that question, Asma, for you. Let's go over to now Naima, to set up a family SSAS. Is it, and we talked about this, didn't we, in terms of family SSAS, business SSAS, Is it worth waiting until my children are both 18? They're currently 14 and 17. Thanks.
Yeah, good question. No, don't wait, because you want to be ahead of your kids. So, the whole financial literacy thing, which is a whole new ball of wax, I guess, is really important to me. So we like to educate the parents to have the right level of knowledge, so that when they know how to run their scheme, run their SSAS, they know how to operate it well, they can bring their children in at 18. You can't be a SSAS trustee until you're age 18, and it's always better to be more knowledgeable than your kids, not do it at the same time. So do it earlier than your kids are 18, yes.
You and I sprung a conversation up, Kevin. You and I know each other probably not as long as what Bronwen was trying to show off with earlier, but we've known each other for some time. But you and I had a conversation which really touched my whole kind of being in terms of education of children. And you're doing an event with families together, aren't you? So can you just explain more about that? Because I think that would be a classic thing for listeners that you don't get taught money inside of schools, and that's a foregone conclusion. But you're doing some brilliant work, so please do give a shout out to what you're doing.
Okay, so the principle is, when I was growing up and I asked my dad about anything to do with money, all I got was a clip around the ear and told to mind my own business. It really wasn't a good lesson. So I'm really passionate about financial literacy in the home. So although it's been in the making for some years, and we've had family meetings with Bronwen and John and other families to talk about the wider wealth issue, but what we're creating formally is Wealth Builders for Families, how to teach parents to be fantastic money role models for their kids. The course is already written. It's kind of ready. It's just going to be launched in the summer. We're going to be testing it with certain groups. And definitely the SSAS is a really important part of that for a number of reasons. One of those, for example, albeit Bronwen didn't mention this as a benefit for her, one of the things I know is true for her is if she had died, in the Lloyds Bank pension, drawing the pension, that pension would have died and wouldn't pass on to her kids. If you've got a SSAS, all of that money passes to the kids because the trust fund belongs to the family. It doesn't close on death. It stays open for the family to maintain.
Which is a massive thing though, Kevin, isn't it?
Huge, Simon. It's such a big, big thing that pensions often die with the person who set the pension up.
That was the clincher. That was the clincher for me.
Yeah.
And because when my father died, my mother got 50% of his pension, only half of it. And then, of course, when she died, that's it. It's gone. So yes,
pensions are safe. And I go, well, guarantee you lose 50% on first death, and guarantee you lose 100% is not a good guarantee.
No.
It's a guarantee, yes, but not a great one.
No.
My dad died
to add to that, though, Kevin, when Bronwen found out about that, she also took out life insurance on John. So, it was,
she did. Took a lot out, thanks to Wealth Builders.
Well, I think the other point here, though, is just going back to the benefits of being a director and having control and choice, is if you are a director, you can get your life cover paid for by your company through something known as relevant life. Not that other life cover is irrelevant, again, weird names, but it means you can basically have the company pay the premium, and the net impact of that, when you boil it down, is about half price. So it means you can afford twice the amount of cover on John, so in case you bump him off in a canoe.
Well, he did the clipper, didn't he?
Oh, yeah.
Clip around the world. So,
right.
We had a good go.
He did bring you a drink in, though, Bronwen, so it's all right.
Yeah. So anyway, the point is you get the premiums paid for by the company, so it's tax deductible. And again, it's a benefit of being a director that often for us sits alongside SSAS when we deal with the SSAS relevant life, make sure they've made wills, powers of attorney, all those sorts of things to protect themselves. And you can pay for a pension review out of your pension, so that's tax deductible. You can pay for a health check, and that's tax deductible. So there are many tax deductible things that business owners who are often so busy, they don't get round to doing things. They're always, oh, I've been meaning to get round to that, but I'm just too busy. I've been meaning, oh yeah, that SSAS thing. I've been meaning to talk about that, but I just got too busy. It's important to find somebody, get comfortable, whoever you resonate with. You don't have to resonate with me. If I've just raised the watermark for more people to do SSASs, whether they do them with us or not, isn't my concern. I just want more people to get the message that it's more important to take control than to give it to somebody to stick a siphon in your pension and charge fees for the rest of your life. I don't like that at all.
Going on to another question, which is kind of another interesting fact, because I swapped jobs quite a lot because I was quite unstable. So I had lots of pensions dotted around as an employee. And I can't remember where all my pensions are. And there's got to be people like that around that could stick them into a SSAS pension. Indeed, yeah, she swiped them up and bought herself a nice handbag. But apart from that, how would you find these elusive pensions that you got dotted around? Is there a portal that you can use?
There's not a portal, but there's a couple of things to mention here. One is all pensions are traceable through the use of your national insurance number. And your national insurance number is pretty easy to find. I've got mine in my memory. I know what my national insurance number is.
And how would you, so you take your national insurance number and where do you put that to get your pension information?
Well, they're traceable by that. Doesn't mean there's a portal for it, unfortunately.
Okay.
And I mean, unfortunately, for people out there listening, rather than the industry who keep the money. So they could easily find it and just go to the National Insurance Register, find out there's a pension, there's got a national insurance number attached to it, and they could repatriate that to the home where it belongs, but they don't, they keep it. You've got to go off and find it. £10 billion worth of money is undiscovered, usually and often by women who get married and forget they had pensions when they were in their maiden name and so on, or people who thought I worked for a company but I was only there a couple of years, so it can't be worth anything, or I worked for a company, the company's gone bust, it's been taken over, whatever. There's a pension tracing agency. I think it's tracing.gov. It's up in Newcastle anyway, you can see it. There are some websites masquerading as that, so watch out for that. And what they do is try and find out about your pension and say, we'll help you find it and charge you a fee. You don't need to pay anybody a fee to find your pension. Tracing.gov. They will help you find any company that's gone bust, any company that has been bought, sold, or whatever, and help you find where that pension is. You can find it and you can move it under your own control, whether you just consolidate it into a conventional pension if you're not a SSAS potential, or you could move it into SSAS. And you can, as I said, the only pensions you can't move are pensions that are already in payment as an annuity. So you're drawing the pension and you're getting a fixed payment because the capital is gone. Public sector pensions. I think that's used to say again?
Like the NHS,
police force, and so on. And any pension where was a final salary and somebody's died and you're receiving, say, the 50%, you can't move that 50% into a SSAS. Because
Kevin, just stop on that thought. I don't know how you work this through, but there's a great question here from Simon who says, if you receive 50% from a pension from a spouse that has died, can you move the remaining 50% to your SSAS pension? So you're about to answer that.
Yeah, you can't do that. So I'm neither psychedelic nor psychic, but that's a question that we get a lot, which is what can you do? Now, if someone's got a conventional pension and a spouse or partner dies, you don't get 50%, you get all of it. And you can move all of that to a SSAS. Even if that pension was being drawn in something called drawdown, where you've got a pot and you're drawing money out of the pot, that's fine. You can move the balancing pot across. But if it's a final salary pension, say we had this conversation and it was Bronwen, unfortunately she died, John received the 50% and he said, I've heard about this SSAS, Kevin, Bronwen didn't do it, but I want to. We wouldn't be able to do it for John.
Gotcha.
Not with that money. So
Right, let's get through some questions because we've got 15 minutes left, would you believe, which is shocking already. But I know it happens.
Time goes so
Always
fast.
does when we've got an amazing group of people here. But Bobo's asked a question: can you use a SAS to lend to a separate trading company as debt so you can invest in residential property? Now,
Already
there's a catch, isn't it?
The answer is yes, as long as the SAS was set up by that separate trading company and the SIC codes work.
Yeah.
And now here we go. This is a question we need to be answering, isn't it? Edmund has asked a question: lifetime allowance and how to mitigate a potential tax consequences as my pension is approaching 1 million. Kevin,
Okay.
the floor is yours.
Lifetime allowance. Okay, so the government, well, we know what they're doing is they're finding as many different ways to recoup and claw back money to to find taxes to pay for the pandemic and other things, and the parties at number 10. So all of those things have to be paid for. The big cut was in entrepreneurs relief from 10 million to 1 million, obviously renamed, but we know it is old entrepreneurs relief. The other one is lifetime allowance. So they've frozen lifetime allowance. Now, it used to be 1.8 million. It's now a shade over 1 million, 1.07, something like that, just over 1 million. Now, the fact that lifetime allowance is there is just to say, if you've got £1 million in your pension, the government are kind of saying, you've got too much, so we're going to tax you. But they don't tax you till you're 75, which means if Edmund is less than 75, he's got plenty of time to do some planning. Some of the things you can do with a SAS you can't do with other pensions. For example, if you've got £1 million in a conventional pension, all the money belongs to you, so you can't allocate it to anywhere else. If it's in a SAS, you could do two things. One, you could do a loan back, so you could lend 50% to your company. You pay a tiny bit of interest to your SAS, so your SAS is growing a little bit, but the real growth is outside of the company, in your trading company or in your property company. So that's one way to do it. So it's using your pension and the tax relief and the tax-free growth to fuel something else in your life. Now, you might pay tax on that, but it's not going to be punitive tax. It's going to be corporation tax probably. Yeah. The tax on the over lifetime allowance, 55%. That's a chunky tax charge. So the other way to mitigate that is to have multiple people in your SAS. You can't have multiple people in a conventional pension, but in a SAS you can. Remember, it's up to 11. So if you've got a few people in your SAS, then you can start to allocate some of those returns to different members of the group. So you could have a little bit of money going to your pot and some of the growth going to somebody else's pot, somebody else's pot, somebody else's pot. So you can start to manage that lifetime allowance and start deflecting it to other members of your family, and you genuinely create a lifetime trust fund for the whole family, which is much better than any pension I know.
Which, Kevin, from my mind, just thinking about that out loud, if you are a parent, and we had the question earlier, didn't we, whereby the 14, 17,
14,
when they're 18 and you've got 1.2 million, you could say, well, actually, do you know what, 18-year-old son, daughter, I'm going to transfer 200,000. Is that possible?
Not as simple as that.
Okay.
No. So, usually I'm cautious about what I say.
Especially when I'm around.
Well, especially when anybody's around, because what you don't want to do is set a rabbit off for someone to go, Kevin Whelan said I could do this. And so there are ways and things you could do. You need guidance to do it. And if you've got £1 million in your pension pot, the amount of money you're paying tax, 55% over that limit. So you get the pension to £2 million, you're going to pay $500,000 in tax. It would pay you to spend a few minutes with somebody who knows how to help you do that.
Correct. Perfect. Let's go to a slightly different question, but related. Is Marcel's asked a question: setting up a SAS, transferring funds from a SIP to a SAS. I mean, that's an interesting one, isn't it? Because they're so very similar. I mean, before we talk about transferring from a SIP to a SAS, what's the key difference from your perspective? Because there are going to be lots of people who aren't sure, well, isn't a SIP similar to a SAS? Could you just clarify the differences?
Yeah, well, first of all, SIP is self-invested personal pension. So the clue's in the name. It's a personal pension. It's just, Usually a SIP is giving you, instead of just a single track, more often than not, a SIP is just giving you more variety and control over the types of stock market holdings you have. Okay, but it's still stock market. Some SIPs will allow you to do commercial property. So the best SIP is going to be got some flexibility in funds and commercial property. What a SAS can do is all of those things, but more. A SIP is still for one person. SAS, you've got the multiple pooling, you've got the loan back, you've got the ways to mitigate your lifetime allowance. You can pay more money into a SAS than you can in a SIP. It's possible to pay in 1 year up to $500,000 into a SAS, 40 grand in a SIP. You can hold gold in a SAS, not in a SIP. You can hold cryptocurrency. Say again?
And whiskey.
I wouldn't. It's possible to hold other investments. I'm not going to go down whether you can hold whiskey or not, but you've got a broader choice, and you've got the biggest thing I think is you've got more control also, not just over the choice of investment, but also over your fees. Because usually when you're paying a SIP, you're paying a percentage of your money. So the person about £1 million, if they're paying 1% to the SIP, they're paying 10 grand a year. SAS going to be £1,000 a year because you're just paying for the administration, because you're doing the work. You're not getting somebody else to do work that you can do for yourself, and you save yourself an absolute fortune. Let me say this. We've done thousands of SASs, and we haven't seen anybody go from a SAS to a SIP. We've seen so many go from SIP to SAS. It's kind of a one-way valve. Once you understand it, you never go back.
I mean, one sassy, one slippy, I would say. So there you go. So let's go to the question. Would you read that out for me?
Of course. So Paul has asked, with personal pensions, which are not SAS or SIP, is it better to take 25% tax-free and then secure a good annuity rate and leave the rest invested as a drawdown pot?
Well, there's a crumbs.
Advice.
This question is so multi-layered with advisory information. I'm going to say, first of all, the rules of taking money out in terms of retirement are the same whether you've got a SAS, a SIP, or a personal pension. So the same rate applies. It's the maximum you can take is 25%.
Tax-free.
Tax-free. Even if you've got 2 million, I mean, you can take 25% of the total, but you'd pay tax on more than 25% of the million. So 250, give or take, is the most you can take tax-free. Now, whether you should take an annuity or not, well, as someone who believes in the power of control, with annuity rates that basically you give your capital away and you get an income for life. It's the same as the defined benefit pension argument. The pension will die with you. So, it's possible to buy an annuity. I would never buy an annuity because I know what I'm doing with my money. Some people can combine a bit of annuity, bit of drawdown, bit of property, so it's possible to combine many things in a SAS that you can't do in a personal pension. So I would say if you're eligible for a SAS, go through those 4 tests to decide, then the blow your socks off test, and decide whether you think sticking with a personal pension or a SIP or a SAS would work best for you. It isn't something I can say would be good for any generic group of people. Everybody is different in the same way as would I buy to let, HMO, service accommodation, commercial to residential? I don't know. Everybody's different. You've got to make a decision for yourself based on your personality, what you see, your circumstances, your tax position.
Yeah, you've got to have independent financial advice. Again, it's got to be done properly, hasn't it?
For the record, I am a qualified IFA as well, so I have the benefit of knowing it from both the personal pension and the SIP perspective and the SAS perspective. So I don't grind an axe either way. It's easy for me to say.
I guess what Bronwen's saying, and quite rightly, is this is a education platform, and if you want to understand your specific scenario, then you should get professional advice, and reaching out to Kevin
or anybody else you resonate with is fine.
I think absolutely. So let's talk about this one. So over to you.
Okay, so Simon is asking, can you allocate the repayment of a loan back from one SAS member trustee to different SAS trustees within the same SAS?
Well, this question belies a misunderstanding. which is when you've got a SAS and you've got trustees in the SAS, everybody's the same. So it's almost like the Musketeers, it's all for one, one for all. So you're not. I talked about you can allocate different types of return, but with a loan back, the money's going to the SAS, and then it's divided in proportion to who owns what. So if you've got two people own 50%, it goes 50%. If you've got somebody owns 20%, 30%, and 50%, it's going to go in those proportions. The more technical ways of reallocating money between different people in different orders wouldn't be applicable here. You'd have to do something different. So in simple terms, then, all SSASs, for the sake of this question, are treated in the proportion as if they were shareholders in the SAS.
Perfect. I'm just going to go to this question. I haven't read the question, so I apologise in advance. But at least it's not about stockings this month. So
yes, we had some interesting questions last time. So just to read out, I appreciate your eyes are getting a bit tired. If you have already paid corporation tax, there's a good one. If you've already paid corporation tax for some profit, can you claim it back and put the profit into the SAS?
Well, you can. I love the idea of a cooperation tax.
Yes.
Yes. Ideally, breaking down to 0%, please.
Yeah. But in the absence of the cooperation tax coming in, yes, anything that you put into your SAS is tax deductible. So essentially, it's the same as getting the corporation tax on the amount that you've redirected back into your SAS, which you then can grow tax-free, and you can use it to support your business, to scale your business, whether it's a normal business, a property business, or any kind of business.
Just go on to slightly another question that's come through. Louise, again, if you would do the honours.
Of course, Abiyadan. So apart from investment in properties, in what other ways can you invest your SAS? Who makes the choice of where to invest, the SAS manager or the owner?
Okay, well, the whole raft of different investments you can make there's only two exceptions, really. One is what we call tangible movable property, which is a bit of a mouthful, but it means if you can ride it, eat it, drink it, wear it, hang it on a wall and appreciate it, you can't have it. Right? Rule number one. Rule number two, certain types of residential property. Certain types of property are exempt residential property, like looking after people with special needs, and you can define what you mean by special needs yourself, certain student halls of residence, things like that. So there are some residential properties you can genuinely own and hold inside the SAS, but for most residential properties you can't. So they're the two exceptions. Anything else is good. Who makes the choice? Small, self-directed. You. However, not all SSASs are the same. So you could choose a SAS from a company that also runs SIPs. And Simon and I, you and I chatted about this recently about a certain company. And when they run a SIP and a SAS book, a group of a bunch of people who owe money, usually the SIP book is bigger than the SAS book. And sometimes they'll write the rules to say, we make the decisions and we'll tell you what you can invest, not you. So not all SSASs are the same.
No. And I always say to people, like when they come to me and say, what did I do? You do need to shop around, that, as Kevin said, find somebody that you like, but also they're different. So, trustees and administrators have different offerings in a way, certainly around education. So that's why, I was really keen to go with an organisation that would give me really good education and knowledge so that I could, and also some advice around, I have an annual meeting with my key guy, Lars, and I sit down and we go, right, how did last year go? What are we going to do this year?
Yeah.
And that's really important for me. I feel like I'm not doing it on my own. I've got a team of people that I go to for advice. And legal advice and everything else. I want to make sure that what I'm doing is right. And I have bought land, I have bought commercial property, I've done loan backs, I've bought, I'm going to be buying a guest house. you know, in the SAS. So lots of different ways that you can do things, but you need to get that advice. You know, you won't get it from one book. You'll get it from
Nor Facebook necessarily.
Well,
Definitely.
you can't Google your way to this.
No.
It's in the same way as you can't Google your way to driving a car or certainly driving a Formula One car or flying an airplane or flying a helicopter. There's some complexity. You can't just Google it and think, well, I've read the book, I can go and drive that thing. You can't.
No.
You need certain instruction. I believe you need that, which is why we pride ourselves on providing that instruction. So the STIG for SAS sort of thing, you know, so we try and help people, guide them so they feel confident, usually for about 12 months. And once they've got that confidence, then, you know, they're normally comfortable, by and large, making their own decisions, but with the ear of somebody else who's a professional. Because, you know, tax law, there's a pension manual there's a book called the Pensions Tax Manual, great if you're an insomniac, but and it changes every single month. You know, so every month there's a change in the pensions law. And you can't keep up to date with this yourself. It's not possible. So you need somebody to say, this law applies to you. Watch out for this. You know, you need to be cautious about that. And also check, by the way, that they've got PI cover. Because if they don't have PI cover, you know, they're putting you at risk.
Yeah, I think Arwen asked the question, doesn't she?
This is invaluable information. I'm sure you'll agree. I've put a link in the below. So this is a link that Kevin and I use to help people with SAS pensions and so on. So please make sure you press that link and get, if you need a SAS pension or move into a SAS pension, then, you know, do it tonight. Don't hesitate, and get your SAS pension set up as soon as you can. In regards to this video, hopefully you found it useful. We will be breaking this video out into smallish chunks. So we've had some great content. So thank you ever so much for Kevin and for Bronwen for joining us. Smash that like button as hard as you can. Give it some angst. You know, whack it once. Don't do it twice because it takes the like off, I've noticed. If you want to
Do it an odd number of times.
if you're a bit angry, maybe hit it 3 times, and then it will bring it back on. So please hit that like button. Please hit that subscribe button. And again, thank you ever so much, Kevin, and thank you ever so much, Bronwen, for being with us tonight.
Absolutely. I think what I have taken away from this is that those who are dabbling, considering, cogitating, keep that going, but start that education journey sooner rather than later. Don't sit on the sidelines, get involved. You don't have to make an immediate decision, as Bronwen didn't, and she took her time to consider what was right for her.
And got the life insurance on John.
And got the life insurance on John as well.
Very important.
But start that learning journey with quality knowledge and quality advice, not necessarily, as Kevin has mentioned, via Google. Go speak to people who live and breathe this and start that journey today.
Yeah. So we've written some guides on this, Simon, as well. So anybody who connects with me, we've written guides for people so they can get a little bit, then dive a bit deeper, then dive a bit deeper. Because if you get too much in one place, confused minds can set you off on different, rabbit holes that can just get you overwhelmed. And if you get overwhelmed, the confused mind always stops and says no. And that's the danger with this. So find somebody you like, talk to them, get some information. There's plenty of it. We provide lots of it at Wealth Builders. In fact, we've created a page, wealthbuilders.co.uk/optimize. So we've got some free downloads for anybody who wants to grab those. So more than welcome to do that. But talk to Simon. We're getting on really well with this. You can see he's an enthusiast.
Oh, we've got more stuff. I was going to say we've got some more stuff. I'm just trying to find the link, so I will put that in there. But you and I hopefully got some big plans coming up in this year, haven't we, Kevin, to try and do some collaborative work going forwards?
Oh, I think so, because it's just too much to be gained, isn't there? And you know, you've got a really strong reputation in your business, and as does Bronwen. And the more people who can at least say, look, find out more about this, be curious about it, but dig a little bit deeper. Don't kind of try and be an expert in an hour and a half. You can't. Just take your time and learn gradually. That's what I would suggest. We're never in a rush to do that with anybody. The patience of a saint was tested with Bronwen.
Yes, but it was worth waiting for.
Worth it. worth it. Definitely for you and for me. I'm very happy with that.
The transfer value did go up as well, so that was rather good.
Yes.
I was
Yeah.
lucky.
And there's the link, guys. So
Yeah,
if you
that's-
do want to, there you go. You can download that link. So
I'm not
thank
sure
you.
there's an oblique at the end of optimize, but you could remove
Oh,
that.
yeah, I've just copied that from the link, you know, as well. So I'm not sure what's happening with that. But anyway, but thank you ever so much, guys. Listen, guys, anyone that is watching this live video, don't forget we do this monthly. So Louise and I will be on the next one. There is that other great show. What's that one called, Bronwen?
Oh,
Golden
It's
nugget.
the property expert panel.
Yeah,
Yeah.
full of golden nuggets, I would say.
Yeah. Next one is the 9th of May.
Perfect. There we go. So good night, everyone, and have a wonderful evening.
absolutely. Good night.
Bye now.
Bye-bye.